Hey everyone, let's start by looking at a tweet in which we were mentioned. Our friends at Review the News asked if we had any precious metals insight in response to this tweet by a fellow named Wyatt with an anime AVI. And his tweet was, "Why is silver $23 an ounce when Congress is about to crap diarrhea through their underwear like a coffee filter all over the dollar?" And our response was to direct them to an article we wrote for Zero Hedge back in February. And the upshot of it was, if silver and precious metals in general were going to react to excess government spending, they would have done so right after the runoff elections in Georgia for the U.S. Senate were finished and the Democrats won, because at that point it was clear that there was going to be record spending this year. That was already baked into the cake. And that precious metals didn't move on that tells you that they're not going to be sensitive to government spending the way, I guess, Austrian economics people would expect. Perhaps it means modern monetary theory actually works, that as long as inflation doesn't move too high, governments can borrow and spend. But we've seen inflation go up. If you look at gas prices, for example, Bloomberg's take on that is that the markets assume the inflation is going to be temporary. I don't have any idea if that's going to be the case or not. But if you own silver, let's look at ways you can hedge. You can limit your risk in the event it goes down further. And some of you watching this probably are saying to yourself, well, why would I want to hedge? Silver's real money. Fiat is going to zero. Okay, maybe you're right. In the meantime, though, if silver goes down significantly, if you hedge, you'll get more fiat, you get more dollars, and you can use that if you want to buy more silver. So let's look at a way to do that. What we'll do is we'll open up the Portfolio on our iPhone app, and we need a symbol to enter here as a proxy. Now, a lot of people like silver, like PSLV, which doesn't even show up here because it's got no options traded on it now. That's the Sprott Physical Silver Trust. So we'll enter SLV instead, which is the symbol for the iShares Silver Trust. And then you want to enter a number of shares that's commensurate with the amount of silver you have. For the purposes of this example, we'll put in 1,000 shares. And then here you put in the largest decline you're willing to risk. And again, for this example, we'll pick a number, we'll just put in 15%. And then, and this question mark, if you forget what threshold means, it defines it. The maximum decline in the value of your position that you're willing to risk. You can enter it as a dollar value or a percentage. If you just put in a number without a percentage sign or a dollar, the app is going to assume it's a percentage. And then the next thing is you pick a time to expiration. You can pick anything as far out as September of 2023, but we'll stick with our default here, which goes out approximately 6 months. So here we're shown the optimal puts to hedge 1,000 shares of SLV against a greater than 15% decline. And you can see here the cost was 4.53% of position value, or $980. And that was calculated at the ask price to be conservative. But in practice, you can often buy and sell options at some price between the bid and ask. So you probably would have paid less for this on Tuesday. This is as of Tuesday's close. So if you want to lower the cost, one thing you can do is you can consider capping your possible upside. Let's try capping it at 10% and see what happens. And here, if we're willing to cap our upside at 10% over the same time frame, which is going out to the end of next March, the net cost becomes negative. Now, the cost is negative 700, which means we would collect a $700 net credit when opening this hedge, assuming we placed both trades, buying the puts and selling the calls, at the worst ends of their respective spreads. In reality, you likely would have collected a net credit of more than $700. But that 700 worked out to 3.24% of position value. So those are a couple of ways you can hedge your silver exposure. You could also try playing around with different time frames to expiration. So for example, let's try November 19th with the same parameters, and we still get a net credit on this of $230, and we can go ahead and erase the cap and stick with this November expiration and see what the put options looks like. And here the cost goes down as you would expect because it's a shorter time frame to expiration, going out to mid-November instead of the end of March. Here the initial cost is $320, or 1.48% of position value. Now, if you want to compare apples to apples, we also show an annualized cost as a percentage of position value, which here is 5.4%. I don't remember what it was going out to default, but let's take a look. We just scroll up and we tap that, and we see the annualized cost as a percentage of position value was 7.13% going out to March. So the annualized cost is actually lower if you want to go out to November. So there you go. Those are a few different ways you can look at hedging silver, and you can also use different parameters to scan for optimal hedges if you like. And it may be prudent to do so in the event, even if you're bullish on silver long term, in the event it goes down more, this would give you an opportunity. It would give you dry powder, those appreciated put options, and you can sell them and use them to buy more silver. All right, something to consider.